private credit to me feels in a bubble territory. I'm not entirely sure there's enough attractive assets with that kind of yield available to put this private credit to work. Maybe the private markets have gone too far in terms of growth, and then now needs to stabilize before it can find its supply demand imbalance again in terms of assets to be acquired. In the private space, you've had those crazy years of returns, 10 or 15 years returns were incredible. Now we're coming out of this super cycle of zero interest rates and everybody being awash with liquidity and deploying a lot. It's going to take time to digest this pump, and I'm expecting that the digestion phase will yield relatively low return. They will still be attractive, I think, in terms of premium compared to public markets, but they're going to probably show a compression of returns. I would be surprised if it's not the case.
Very pleased to welcome to Monetary Matters Jean-Baptiste Wautie, a veteran of private equity. He spent time at Morgan Stanley. He was at BC Partners, where for over a decade he was the chief investment officer, co-managing 40 billion euro of assets. Jean-Baptiste, welcome to Monetary Matters.
That's very kind. Thanks for having me, Jack.
I'm really glad you're here, Jean-Baptiste. I just asked you, how are things going? How's your 2025? You said a little bit hectic. Jean-Baptiste, if you were a veteran not of private markets, but of public markets, that would make sense. Interest rates are moving up, tariffs, stocks are dropping out of bed, stocks are rallying, but private markets are supposed to be a little bit more calm. So tell me, how has 2025 been hectic for you as someone who's been in private markets? And just generally, do you find that private markets are affected less by the news cycle and sort of the drama, the gossip that's on the FT.com or Bloomberg and the like?
It's a great question, Jack. I think, let me answer in two ways. Private markets have never been immune to what's happening on the public markets and on the macro scene in general. There was a study that I think it was Columbia conducted a long time ago to look at what was the biggest correlation factor behind private equity performance. And the answer was, and I think the R-square was like close to 100. The answer was the vintage year, the year in which the funds were invested. And it's no surprise because it's a cyclical industry, and it's a cyclical industry because it just follows the macro cycle and the public valuation cycle. So I would say that a lot of the things that are on public investors' mind nowadays will be on private investor minds as well. And I continue to, follow what's happening on the monetary front, interest rates, the stock market concentration, the volatility that's back, and all the rest of it. Now, where private markets can be a little different is that you don't look at things for the next hour, the next day, or the next quarter. You have a bit of time ahead of you. And so you can plan how you deploy and how you realize your assets over a much longer period. So it's less frantic, if you wish, in terms of decision making, because if you don't think right now the window is good, you can wait for 3 months, you can wait for 6 months, you can even wait for a year. Now this has its limits, obviously, because if you are a large fund, you need to deploy and you need to return money every year to your large investors, but you have this ability to time a bit more and even to wait for better windows that sometimes in public markets you don't have the luxury of.
And Jean-Baptiste, how would you summarize the performance of private markets, private equity, private credit, pretty much, let's say everything except for venture capital in 2024? For public markets, we could summarize it pretty quickly. A banner year for markets led by NVIDIA and the like. Good year for financial stocks as well. I'm just looking at Blackstone reported earnings, and for their investment performance for their limited partners, LP, so their actual investors. Private equity returned 16.6%, and private credit returned 15.7%. So very good, underperforming the S&P, but still, if you can do that every year, that's quite good. Just looking beyond Blackstone LPs to the broader investment universe, how would you summarize in terms of returns, in terms of carry, in terms of fundraising, in terms of other metrics that maybe I and perhaps some other viewers don't think are important, but you as a veteran know are important? Like what, besides those factors, what else is important?
Of course. So, and remember what I said about, the timeline and the typical horizon in private equity. So I'll answer your question about 24. but you should never look at just 1 year in isolation, because your investors will look at a vintage, they will look at the fund performance. But let me answer your question first. So I think 24 was a good year in the sense that you've seen, first of all, you've seen the resumption of M&A market, which leads to better realizations. And the biggest issue that private equity had back in 22, 23 was that M&A markets were pretty much not shut down, but were down 50, 60, 70%. And therefore, the ability to realize your assets was a lot diminished. And they didn't like the valuations that they were looking at because there was still, some asymmetry between sellers and buyers' expectations. So they were really, really behind in terms of returning capital to investors, which is, if you ask most LPs today, they will probably tell you it's the number one metric they're looking at. It's called DPI, which is distributed overpaid, which measures for one given fund how much capital have you returned versus the capital you've called. And because private equity had COVID years where realizations were low, and then it were 22, 23 where M&A markets were still not that booming. Private equity in general was really running behind in terms of returning capital. So 24, you haven't caught up on all of those years of lower distributions, but 24 was pretty much in line with what LPs would have expected for 1 year of distribution. If you look at portfolios, that's back to your initial question on public versus private. It pretty much followed the public markets, because the way you value your portfolio is typically based on public comps, public comparables. So if the stock markets are appreciating across sectors, it's going to lift all boats. So it's just it's a fair market value. So it remains to be seen whether you're going to be selling your assets at the mark you're showing. But the numbers you were referring to, a lot of this will be where the mark is, as opposed to whether you've realized the whole fund. And so public markets are trending well. Usually private equity portfolio are trending well. Is it encouraging? Yes. Does it mean that, again, your assets are going to be realized at that level? Until you sell it, you don't really know. So that's the second thing that you would typically look at, is where the portfolio mark is, and have you increased your marks over the year. And then the last key metric is indeed fundraising, and this has remained really difficult, and I think it will remain for the time being, and for the next few years, and we may discuss that further. But private equity is really going through a consolidation phase, a digestion phase. You've seen a lot of capital being raised during the heydays when liquidity was abundant and valuations were only going one way. But you're entering a phase of consolidation where it's not going to be as easy as the last 10 or 15 years, for obvious reasons, largely monetary. And there's a push by LPs to really consolidate their relationships. And so fundraising, add to that the fact that a lot of these funds have succession issues to manage, because the pioneers or the builders are pretty much retiring, and it's the next generation. And you end up with a fundraising market which is going to be tough. Combination of what I just said, but also the fact that you've returned less money, that private equity investors learn the hard way that it's an illiquid market, even though secondary is on the rise. And you're going to see a lot of renewed prudence and wanting to consolidate relationship on the LP side, which means that some funds will have much more difficulties raising, and some of them may not raise at all. And we're seeing the first sign of this in 24, 25.
So you're seeing private equity firms struggling to raise. Now, Blackstone, they're still raising money, but you're more concerned maybe about the fundraising ability of smaller private equity companies. And I just looked it up. Just in the US alone, there are 11,000 private equity firms. That's insane.
It is a lot, and it is hard to compute indeed. It's exactly that. I think you today, there's no science behind what I'm going to say, but you're probably looking at critical size is around 100 or 150 billion of assets under management. Diversified global, multi-product with no succession issues or no key man risk. That's probably the typical GP that's going to strive and continue to grow. And Blackstone is the number one. They're by far the largest, by far the most diversified, by far the one that will continue to strive. You could add in there Apollo, you could add in there KKR and firms like that. There's very few Europeans who belong that category. Probably only two, which are EQT and CVC, which are both listed. These are recent listings, but they both have the similar, they're way above the 100 billion mark, and they tick all the boxes. So these guys, they will continue to strive, they will continue to grow, and they will continue to consolidate. But indeed, you have a long tail of funds, even with tens of billions under management, but which are going to have, again, a hard time, surviving this consolidation phase, let alone raise for some of their flagship indeed.
And JB, I know you're involved in the economics front on the in academia. In a lot of economics, I don't know if it's just so the equations are simple or so that you don't get infinity as a result. There's an assumption that returns go down as scale increases, or so that to make 1,000 teddy bears will cost less than to make a million teddy bears. But I think in many instances that's not true. And while I think it's definitely in terms of LP returns for definitely hedge funds, that's true of scale. So you could probably, Warren Buffett has said he could make 50% a year if he was just dealing with small sums like he was when he was 20 or 25. But to make 50% on $300 billion is basically impossible. And I bet that's probably true in private equity and private credit. You tell me. But what you're talking about is in terms of network effects and scale, in terms of fundraising and the GP of, let's say, raising from Harvard or Yale. Harvard or Yale only wants to give maybe to funds that already manage $100 billion because they want to give $10 billion, and that's they don't want to become too big. Do I have that roughly right? Tell us your thinking about that.
You spot on. So let me. There's a lot of important things in what you just said. Let me unpick some of them. So first of all, in terms of why LPs are pushing to consolidation, you spot on. I.e., first of all, they themselves are growing and they're compounding. And remember what you said about yields and returns. I'll get back to that. But to counter that, you have scale effect and compounding in the asset management space, because at the end of the day, private equity is just a bunch of asset managers. They just happen to invest into mostly private companies, but they're asset managers. And there is compounding there. So your LPs are indeed compounding. They're getting bigger, and because they're getting bigger, they need to deploy bigger commitments. And we've seen that trend over the last 20 years. I mean, every time we would raise a flagship, those large LPs of yours would say they would start at 200 million, and then they were 500. The next thing you know, they wanted you to manage 2 or 3 billion for them. Combination of 1 billion maybe in the flagship, and then some separate accounts that you would manage on their behalf. So that's one element indeed. They have more money to deploy every year. The second driver is they're trying to lower the cost of deployment, the average cost of deployment, and you can do that if you put larger tickets. It's a very basic. The bigger you are, the bigger the discount. And so this is the second driver. The third driver is what we briefly alluded to in earlier, which is the key man risk. Historically, this industry, you had a bunch of very smart, successful deal makers getting together and yielding fantastic returns. And individually, they were great investors, but most of their firms were relying on one, two, a handful of key individuals. Now, these people, when they retire, what about the firm? What about what's going to happen with people's commitment? And in private equity, you commit for a very long period. You typically commit for 10, 12 years. So not only you don't like the key man risk, but you like it even less in private equity because you stuck for so long with a manager. So more and more, and this trend started again maybe 10 years ago, institutional investors were looking for firms, institutions, not just very smart and successful investors. And that's why it pushes you towards larger firms, because if you're small firms, you're going to be dependent on a few key individuals. If you're larger, you're much more diversified. So whereas there's not an obvious rule in PE which says the larger you are, the lower the return. It's very hard to measure. You would need to measure by looking at funds. So you would need to isolate within Blackstone, maybe the LBO fund. You would need to make sure that it's the same vintage as Apollo's or KKR and a smaller guy, and then you would need to look at the performance. It wouldn't show you that they're miles below where the sort of the top quartile would be. They're usually in the range because, yes, granted, they have larger pool of capital to deploy. And this is where Warren Buffett is right in terms of finding alpha in the private markets, but they also have great team depth, processes, reach, leverage, and all sorts of things that are going to partly compensate for that. So the extra yield that you might get in someone who's incredibly niche and incredibly good at deploying is a bit outweighed by these advantages. And in the eyes of the investors, they may accept a slightly lower return anyway in exchange for larger amounts deployed and better risk profile. Because if this extra 2% of return come with a huge key man risk, if you're an institutional investor, you're probably not interested in that trade. So that's why, even though of course some of the theory applies here, it's not entirely applicable to the asset management space and private equity in particular. And this is why you still see that consolidation trend.
Tell me about that key man risk. Why is it that the CEO leaving or becoming old, retiring, why is it that person is so important? Is it because of actual alpha on the deal making side, or is it in terms of fundraising? Like, I have tons of respect for Mark Rowan. He's so smart, and obviously he's really led Apollo in a great direction. But is it really the case that he's not the one who's making the deals? He's got a very talented team. Like, if he leaves and there's a new CEO, the talented team is still in place, right? Why is it such a key man risk that if Mark Rowan leaves? And by the way, I think the stock Apollo traded down briefly when there was rumors that he was going to become Treasury Secretary, which he obviously did not.
Yeah, no, yeah, and you're right, but you're picking the wrong example in the sense that Apollo has become an institution. It has been just like Blackstone, just like KKR. These have become mini Goldman in the sense that there's no longer a CEO risk, and you're absolutely right. When Goldman CEO retire, it's always oh my God, what's going to happen, and nothing ever happens. And Goldman continues to strive, and it's going to be the same for Apollo. It's going to be the same for Blackstone. When John Gray took over from Steve was an absolute legend. Things continue to, and John is a fantastic investor and leader. But it's just to say that the institution is much stronger than just the CEO. The reason why I'm saying you picked the wrong example is, again, those have made the cut. The institutions now. I was talking about the smaller guys, the ones at risk in that wave of consolidation. If you look at the European managers who are in the sort of 40 to 70 billion of assets under management, which in a way, just in private markets, that could be seen as large, if not very large. They typically rely on 2 or 3 very successful investors who've been deploying and generating a good bunch of the capital gains over the last decades, and who have been the ones determined to be the key man when fundraising. And so to get back to your question, those key men in those subcritical GPs do everything. And that's why there's a key man risk, because they're the ones that LPs are going to trust because they have a long track record of deploying capital and generating capital gains. They are the one where they're going to be concerned if they leave, that they want to be able to take their money out, or their commitment out. So they're going to be the ones fundraising, and they're going to be the one who are going to have to commit that they're going to stay on board, that they're going to invest some of their personal money, that they're not going to leave tomorrow, etc., etc. These were the ones I was referring to.
Okay, thank you for that. And JB, so you think private equity fundraising is slowing down? Do you think that's going to impact returns? And do you think there's broadly a correlation between inflows as well as performance? Like when everyone flooded money into private equity in 2021, was that related to the fact that uh, the performance was so good? And I mean, that's obvious, but was the performance so good because of the inflows? And if the inflows slow down, is our performance going to suffer as well?
So it's hard to measure, but bear with me. The reason why I'm saying it's hard to measure is because you're going to commit to a fund. That's when you measure the fund being raised. That's the fundraising stat. So Joe Blow Partners is raising a fund. I'm going to commit 200 million in 25. That's measured in the fundraising stat. There's 200 million in 25. Now, these 200 millions are going to be deployed over the next 5 to 6 years and are going to generate return in 10 years. And not only they're going to generate returns in 10 years, but they're going to generate return across a lot of portfolio companies which will have been bought in the meanwhile. So it's very hard to sort of track that euro of commitment in 25. Is it impacting returns upwards or downwards in 35, say? Now, where I think indirectly you're probably pointing to something that is true, is that there's not an infinite amount of assets, especially in Europe, but even in the US, which is the deepest market by far for private capital. There's not an infinite number of assets, and the more competition there is, the thinner the returns are going to be. So I think you're probably broadly right, but you would need to look at over a long-term trend of funds being raised and effectively assets under management in the private space. It hasn't shown yet because you've had those crazy years of returns, 10 or 15 years returns were incredible. Now we're coming out of this super cycle of zero interest rates, lots of liquidity, M&A markets wide open, and the everybody being awash with liquidity and deploying a lot. It's going to take time to digest this pump, and I'm expecting that the digestion phase will yield relatively low return. They will still be attractive, I think, in terms of premium compared to public markets, but they're going to probably show a compression of returns. I would be surprised if it's not the case, and it will be indirectly linked to the fact that maybe the private markets have gone too far in terms of growth, and then now needs to stabilize before it can find its supply demand imbalance again in terms of assets to be acquired.
And then that's private equity. Talk to us about private credit, which is just lending money not in the high yield bond market.
Private credit to me, and again, I can't scientifically prove what I'm going to say, but feels in a bubble territory. And I'm saying this for a couple of reasons. Number one, we're back to the question you asked earlier. I'm not entirely sure there's enough attractive assets with that kind of yield available to put this private credit to work. So either they're going to go to riskier assets, or they're going to go with lighter covenants or no covenants at all, or they're going to just sit on people's balance sheet and not being deployed. But I don't think the pool of opportunities has grown so much for private credit that it justifies that the likes of Ares are raising more north of 20 billion. I don't see that. And the second thing is that you have right now in the market, you have evidence of what I'm saying, which is there's a lot of people who are thinking that high yield markets and private credit markets are just too frothy. To me, the only thing that could balance out the whole equation and for private credit to remain attractive is really if banks continue to retrench and private credit becomes the biggest provider of money to private equity. It's hard to see whether this is going to happen, because traditional banks right now, if anything, they're trying to compete to avoid losing market share because high yield is a lucrative business. and even trying to get into private credit themselves. If you look at what the likes of JP Morgan or Goldman are trying to do. So I don't think banks are ready to just just give the keys to the private credit lenders. They will always be handicapped by regulation. But with the new administration in the US, it looks like the regulation is going the other way, or it's going to facilitate their work. So, I mean, listen, I wouldn't necessarily invest in private credit myself now. So that tells you all you need to know. But to me, it's there's a lot of imbalance right now. If anything, there's more imbalance in private credit than private equity, I think.
Very interesting. And private credit has grown so much, and the returns have been, somewhat good. In part because you referenced regulation after the 2008 great financial crisis. It was much more expensive for banks to be involved in this type of risky activity. So a lot of that risky lending moved outside of the banks and outside of the high yield market, in fact, to private credit, direct lending, CLOs outside of the banking system. And so are you saying that if the Trump administration is actually more friendly to banks, that trend might reverse, so it's actually good for the banks, and the banks might reclaim a small amount of the share from the private credit?
I think there's a decent chance of this happening indeed. The combination of regulation being pulled back a bit and traditional banks not being willing to abandon a lucrative market for them. If you ask any lender working at a large bank, they would be the first to tell you that regulation had become a nightmare. They would have 50 or 100% from the SEC at any point in their office. They had to make exceptional use of what they call special mention, which is when the leverage would be a bit too high and things like that. So it had become an absolute nightmare for those banks to go into some high amount of leverage on LBOs, irrespective of the risk they would see in there. Again, if it's being pulled back a bit, and given what they're seeing in terms of competition from private credit, they may manage to maintain their share indeed.
And JB, so that is a mega trend over the past 15, well, I guess now 17 years of regulation after the great financial crisis. But in terms of the past 4 years, the golden age of private credit, we haven't started hearing about that until 1 to 2 years ago. What is it about this golden age where the fundraising has just exploded?
I think you're absolutely right in terms of this recent explosion. It feels to me like you had a combination of factors. The first one is, I think, a greater portion of investors woke up to the asset class. It was something that was a bit arcane and poorly understood and all the rest of it. And suddenly, you first need to understand, okay, what's the level of default and risk I take when I go into the private equity space? How can I observe this over the long period? Is default much higher? How do these people do their due diligence? Are they that rigorous in terms of how they deploy capital? And finally, I think there was also an element of it was a bit of a fad. Like everyone was just talking about private credit and saying, with this belief that, oh, we're at the end of a cycle, so there's going to be a sort of a restructuring bonanza, or a lot of balance sheet that will need to be reworked. That's when private credit will be incredibly agile and will generate fantastic return. Now they were looking at returns from a period where private credit was 10 times, 100 times smaller. So this is where your rule applies, which is, the very beginning of private equity, I don't know, 30 years ago, or the very beginning of private credit, 10, 15 years ago, were golden years, because you were just picking up the best assets, the ones that bank didn't want to touch, either because they didn't know them, or because they had the wrong appreciation of risk, or because regulation was preventing them from doing yet another special mention in that given year. So they would pick fantastic assets, generate fantastic return, and all of that in a period where, again, the tide was lifting all boats, including if you were a lender. we've entered a very different phase now. What I'm trying to say is I think this is a bit late in terms of adjusting to the market opportunity, and it's a bit too drastic in terms of amounts being raised. So that's why I'm expecting you're gonna see some correction or some disappointing returns from that vintage.
Mm. And maybe my explanation is too simplistic, but I think just in the fixed income world, obviously there were huge losses because of duration, because interest rates went up, and private credit mostly is a duration zero asset class of floating rate. And so when interest rates go up, it imposes a mark-to-market loss on long duration fixed rate loans, and it implodes, no mark-to-market gain on floating rate loans, but there's an earnings gain just because the yields are higher. But maybe that's too simplistic. And so the private credit, I'll divide it into three things. Number one is direct origination to companies, non-sponsored. So direct origination to companies that are not backed by private equity. And then there's origination to the companies that are backed, sponsored deals. And those are the deals that have replaced banks. And then there is investment grade private credit, which is something I've heard of less than a year ago. But I mean, Apollo says that it's Athene, it's owned annuities and an insurance business, that 97 or a high over 90%, well over 90% of its deals that it invests in are investment grade. So where are you seeing the biggest risk in those three asset classes, and which one do you like the best?
First of all, I think you're right in terms of how you categorize and this duration does play a role for sure. Now, go back to three categories. I see probably more risk in the sponsor-led. Reason being that this is where you've seen a huge spike in volume, a lot of competition, and therefore private credit funds maybe being a bit too loose in either their due diligence or their documentation or their pricing. And I think this is where if I try and think both in numbers and also in risk level, this is probably where it's been a bit too lax, because when you talk about sponsorless, what you call direct lending, this is typically much smaller assets, less competition. There's either a direct relationship with the owners or the management team, or there's a deep understanding of forces at play in that particular sector for that particular company. So usually it's the risk is really well priced, and usually you have comfortable margins on those deals. They're far less competitive. Direct lenders have a better edge. They have time to do their work. So this one, but I think it's much smaller volumes, because again, it tends to be much smaller assets and much smaller quantums of debt and lower leverage. When it comes to the investment grades, it's fascinating because you're right. You see it at Polo, you see it at Blackstone, of course, and a few other managers. I don't think I think it's decent in terms of risk reward, but we're talking about yields which are not necessarily that attractive when base rates are around 5%. That's more where my issue is with these products. Is that how much you want to get paid if you're taking an investment grade risk with, I don't know, a company in energy or tech or healthcare or whatever it is, where the spreads are really not that big. And fair enough, these companies have a strong market position, usually good balance sheet and all the rest of it. But you're being paid very little spread for the risk you're taking compared to the base rate. And so this is where I'm sort of torn, because although I don't think the level of risk and default and stuff is much higher, I think you're not being paid for taking an investment grade risk compared to where the interest rates are at the moment.
Mm. And so the company that you were the chief investment officer of, BC Partners, so they started primarily private equity business as well as co-invest. I don't really know what that is. You can tell us what co-invest is, but they started credit in 2018, which is now 7 years ago. And they write on their website, BCP Credit is synergistic and complementary to the private equity business. So how much of private credit is sponsor? So private equity company or private alternative asset firm A, their credit arm lends to the private equity arm of alternative asset firm B, and then the private credit arm of alternative asset firm B lends to the private equity arm of alternative asset firm A. Obviously, there's so many, 11,000 private alternative asset managers in the U.S. So, but I mean, are the links there? And can you see how if there's tons of inflows, everyone's kind of propping each other up on the way up, and on the way down, it might be ugly.
Co-invest, before I talk about private credit and the synergies, co-invest is when an LP who's already an investor in a given fund is going to invest alongside the fund, but directly. And typically, it's reduced fee, reduced carry, sometimes no fee, no carry when you really need them. So it depends really on the bargaining power on a given deal. And there's been a lot of development of co-invest because typically LPs, I'd rather put a large ticket into the fund and then pick the assets where they want quote unquote overexposure. And by doing that, they deploy more, they pick their sort of additional risk to the portfolio, and they do that on a reduced cost of deployment because, as I said, it's reduced fee and carry if they invest directly in an asset where you need them. So that's what co-invest is, and this has been developing over the years for obvious reasons. Back to you, and you have that both in all private equity asset classes. You can have that in equity, but you can also have that in private debt. Back to your question on synergies and the like. So at BC, the idea was in terms of synergies was not so much to go into deals where BC was present, because you have all sorts of conflicts of interest to manage, which are an absolute headache because you don't have the same set of investors in your flagship than you have in your private credit fund. So you need to properly manage interest, make sure that there's no conflict and all the rest of it. You need to Chinese wall the information. So it's very, very complicated. It's not easy to manage. It's not easy to make sure that you properly manage the conflict of interest. So you would have very few of those for those reasons. What you typically had and still have in terms of synergies is more either the P fund is passing on an opportunity because they don't like the risk, they don't like to invest in equity, they don't like the sector, they don't like the size, whatever it is. But it's still an interesting risk profile for a direct lender. So you have synergies at sourcing, which is again where the flagship will have passed, but your credit arm may think it's a very good risk reward if you get into the debt as opposed to the equity. You have synergies in terms of your sort of understanding of a particular sector, particular trends, particular geography. So there you can totally leverage the existing platform of BC partners, and you have a lot of people who have a long experience in their respective sectors. You have synergies in terms of back office. Think of teams that you need for investor relation, fundraising, finance, and all the rest of it. These are, of course, you need to hire, but you hire at the margin as opposed to needing to hire a full team from scratch. These would be your typical synergies, and they're real. I've seen them, really functioning for a long time. The only caveat I would put though is that the size of the funds, we're talking, the first fund was $700 million. The next fund was $1.5 billion. So we're talking small, in the greater scheme of things, we're talking small amounts of capital to deploy in that market. And that you can still do what we were just talking about earlier, which is pick your risk and make sure that you have very decent risk return profile in the portfolio. And that's how the BC Partners Credit has been delivering performance. It's because they could really pick their spots, benefit from a large network that BC Partners has, 3 decades of sector expertise and the likes, and they didn't need to do 100 deals a year. They could really pick the most attractive. So if BC had funds of 10 or 20 billion, it would have been very different on the credit side. And the last thing I would add is it's a combination of that and BDCs, public BDCs, which again is a scale game, but is a very attractive risk reward. You were talking about Apollo's foray into the space, and then insurance. Apollo were actually the pioneer in identifying that market opportunity, and this is something that we did as well when I was at BC, and that is still growing.
You bought an insurance company,
no, small public BDCs.
BDCs,
that we took
yes.
private. Yeah, BDCs that we took private. And this is, again, we're talking in that space, we're talking a few billion. So it's still, relatively small, even though it's a very attractive and profitable niche. But that's roughly, trying to answer again your question. That's where the synergies were, and that's what the strategy was.
Okay, so that makes me think of another hot buzzword in alternative assets: perpetual capital. Money, it's not you raise it for 5 years, you have to give it back, you have to raise it all again. It's perpetual capital. It is, Berkshire Hathaway owns Geico, the shareholders, it's perpetual. They have insurance float, they invest that in the stock market as well as bonds. Apollo did that with Athene. So perpetual. So I think maybe I'm missing one or two, but perpetual capital, I think of business development companies, BDCs, that go public and use that money, and it's a public vehicle. I honestly don't know if it's like redeemable or open-ended, close-ended, but I guess, what if everyone wants to sell the BDC at the same time? Then it's, not perpetual. And then insurance, okay, that is perpetual. But I guess there are risks there that are probably not regulated. And then I know I'm missing one or two in terms of perpetual capital, but what do you think about this? Because everyone wants to be perpetual now.
Yeah, and rightly so, and this is a trend that BC was not immune to. The one you're missing is when you raise capital for the GP itself. It's GP stakes, and you sort of build yourself a balance sheet, which is something we did when I was at BC with Blackstone. So if you step back, why this trend started? Well, it's exactly for the reason you've alluded to, which is it's purely risk management. If you only raise funds, you're putting your franchise at risk each and every time you raise a fund. If for whatever reason, your performance sucks, your key men have left, whatever it is, you might end up not raising a fund. If you don't raise a fund, you're pretty much gone. Or at least, when you were back in the days when you were very dependent on one strategy, your firm was gone. So the answer to this was grow, diversify, raise permanent capital. Grow, we've talked about. Diversify, because suddenly if you have different strategy, different funds, hopefully you don't mess up all of them at once. And, okay, maybe one fund didn't really deliver, but a lot of them have. And that's why those big franchises like Blackstone and Apollo can absorb a poor performance on one given fund, because it's one drop in their ocean. And then raise of permanent capital was driven by two things: building a buffer to avoid and create a real balance sheet to finally have a firm and a balance sheet, as opposed to, I'm just a short-term company and I may disappear in 10 years. But also invest in your new strategy in order to seed them and accelerate your diversification. That's what we did when I was at BC. The reason why we raised capital with Blackstone was, of course, to create a bit of permanent capital, but this money was reinvested in BC Credit that we launched in 2018, and then BC Real Estate that we launched the year after. And that's why you've seen this trend of trying to raise permanent capital. It was both trying to become institutions and trying to become more resilient to fundraising. The ultimate permanent capital is being listed, obviously, and that's why you've seen a lot of these asset managers trying to IPO and enjoying being listed. Because suddenly, it's not just that you have dollars on your balance sheet; you also have a currency, and hopefully, that currency, will appreciate over time. So you're right. This has been an absolute imperative strategically for most firms which wanted to grow and becoming more institutional and manage their risk better. There's been various ways of doing it. I've talked about IPO. The way we did it was you have basically three asset managers out there who have strategy dedicated to taking stakes in GPs. So Blackstone has one. This is the one with whom we did our transaction back in the days. Then you have, the ex-Dial guys, and then you have Peter Thiel, which is part of Goldman Sachs. And these three have been taking stakes into GPs, which was a way of investing LPs' money, but also on the receiving side, raising permanent capital.
What about Blue Owl?
Yeah, that's the old Dial.
Oh,
That's
Old
that's the
Dial.
new
Okay.
name of yeah.
Yeah, I heard about Blue Owl. Obviously, way after you know it. It was
Yeah.
a SPAC, and I thought of them primarily as a private credit business. But then I actually looked at what they did, and I'm like, what is this GP stakes, GP
Yeah,
minority stakes? And it's a huge amount of volume.
it
And
is.
yeah, I mean, Blue Owl is growing tremendously quickly, so it's a
Yeah.
talented entrepreneurial team. I don't really know much about the assets, but in terms of if the best alternative asset firm is the fastest growing one, then Blue Owl is definitely one of the best.
Yeah, no, they've been on a roll, and it was indeed a merger between Dial and sort of reverse merger into the SPAC by Dial into Blue Owl, and their businesses were nicely complementary. Their vision was what we discussed earlier, which is the more scale, the more diversification in the space, the better. And right now, yeah, they seem to be doing well. The only issue with the GP stake strategy, and this is probably why also Dial wanted to diversify away from that, is that there's a finite number of opportunities. There's X number of GPs in which you might want to take a stake. They're only going to sell 10, 15, 20% of the company. They're never going to cede control. And so once anyone has invested in the 10 or 20% of the GPs that are seen as the best managers, there's no opportunities left. So it's not something that's going to renew over time. So that's why you can't be just reliant on a GP stake strategy, because there's a finite pool of opportunities.
But JB, as we said, there are over 11,000 private equity companies or alternative asset firms in the U.S. That's a big pool, right?
That's a big pool, but out of these 11,000, there's probably a fraction of them in which you want to invest, because a lot of them will be smaller, key-man risk, not
Mhm.
diversified, and all the rest. So GP stake, you really need to see this as it's most of people who invest in those, either very smart alternative investors, but by and large, the large amounts are coming from the same LPs as the one who invest in traditional private equity strategy. So there is an appetite for risk, but not a crazy appetite. These people understand what they're investing in. And if they're reducing the number of GPs in which they're investing because they want scale, they want diversification, they don't want to keep on risk, that means that out of these 11,000, only, I don't know the number, but only probably a few hundred of them will be seen as attractive and sustainable business model. So that's why the pool is actually much more reduced than the total number of GPs out there.
And because your view on the consolidation that the best one, the biggest alternative managers are just going to keep on getting bigger, and the smaller ones might struggle. I take it you're not terribly bullish on the basket of all GPs, right? GP stakes.
No, absolutely, I'm not. I think it would be foolish to sort of invest in all of these 11, irrespective of their recent performance, by the way, because again, when you invest in those GPs, typically you invest. Okay, but usually the way it's structured is you have a sliver of carried and a sliver of management fees. Sometimes you just have a sliver of management fees. And if you only have, but even if you have both, um, you management fees are entirely dependent on the ability of this manager to raise funds in the next 20 years, and hopefully, at the minimum size and with a minimum amount of fees. Otherwise, your dividend stream is going to go to zero. So you vary, and indirectly, it's the same for the carried, because the carried will be generated by those future funds. So you really care a lot about the franchise and the platform and the key man risk and the scale and who are the investors backing those people, and of course the performance over the long run. That's why, out of the 11,000, very few are going to tick all those boxes, and because it's usually an investment that you make over the long term for the next 10, 15, 20 years. Sometimes you don't even have an horizon. You really care a lot about the platform risk. Hence why it's going to be a much narrower set of opportunities.
And what was I going to say? So looking at GPs, so the actual management company, a lot of those are listed now. Are you an investor in any GP stocks?
So I invested in CVC at IPO, but I sold. They had a nice pop, and it was very opportunistic on my end, because I sort of thought it had been a failed IPO for a few times. They really needed out, and the timing was not that obvious. And I was thinking, even if there's no pop, there's always going to be a decent dividend yield over the next couple of years. But it had a nice pop, and I just exited once I was up 30%. I haven't invested in the others. I think they're very sound managers, but they're not that exciting in terms of public performance or in terms of dividend yield. I think they probably belong to a portfolio. If you have a very large institutional investor, that's probably a very decent base to have in your portfolio. But if you're more sort of a stock picker, if you're more looking for alpha, or if you're looking for a different risk profile, they don't perform that terribly well. Those stocks, most of them, they don't go down, but they don't go up that much. And the dividend is not super exciting. It's decent, but I know for a fact that it's always at risk because it depends on fundraised and realizations. So I don't find them super exciting as an investment on the public side.
JB, maybe I misunderstood you, but I thought in our previous call you said you were an investor in Blackstone and Apollo. Were you an investor in the LP, not the GP?
Yeah, in the LP, yeah, in
Okay,
some of their
LP,
vehicles.
Yes. Well, JB, I'm someone who I'm, become familiar with the accounting of banks and balance sheets, but not as much with private equity really at all. And it's kind of a black box to me. So, in preparation for this, I was just looking through like the Blackstone GP, the Apollo GP. And to me, there's something I don't really like understand, because the earnings aren't that good. I know there's a lot of money that's being made, but the earnings aren't that high. They trade at very high multiples. And then also there's a lot of non-controlling interest, which is, I guess, maybe also paid to the founders. But maybe it is as bad as it looks to me, but probably there's something that I don't understand there, because I'm a novice in this space. What am I missing, or is my judgment correct?
So some of your judgment is correct. There's a few things you're missing. So where you're correct, and that's what I meant when I was saying it's a bit too lumpy and the dividend yield is not that good, is because your earnings are never going to be that spectacular. And not only that, so that on that you're absolutely right. And that's why I don't see them as a good dividend yield stock, even though in theory, you have a very stable stream of cash flow from management fees. Now, you also have a lot of costs, and these management fees are supposed to cover all of your fixed costs that the asset managers have. And the other thing is, a portion of your earnings depends on your realization usually, because usually, again, those stocks, it's a stream of your earnings, but it's also some of the carry. The carry depends on your realizations, and if you've had poor years, as we said at the start of this conversation, in terms of realization, you're going to see a zero or a very small number in terms of contribution to the stock performance, and it's always going to be lumpy. So you may have good years, you may have bad years. The third aspect that you're missing is not only it's lumpy, but there's a huge lag. Well, first off, you invest for a long time in those underlying assets, in those portfolio companies. You're going to keep them for 4, 5, 6 years. And second, when you sell those companies, well, first of all, it's going to take you 6 months to get to a signed deal. And once the deal is signed, it's going to take you another 3, 4, 5 months to close. And once you've closed, it's going to take yet another many more months for this to convert into potentially carried. And if you take just one given fund, you don't get into carry territory for a very long time, because first you need to return your capital to investors. Then you need to generate, I'm simplifying, but you need to generate the hurdle rate, which is the minimum return you're guaranteeing to investors. And only then you can start paying carried. So you first need to fill in that bucket of returning the cost, paying the hurdle on all of the fund, and then you start paying carried. So this is huge lag before, for one given fund, you're going to see a single dollar of carried. Now, of course, when you invest in behemoth like Blackstone or Apollo, which have tens of funds, if not hundreds of funds as underliers, you tend to, not eliminate but diminish that element, but you still have some underlying lumpiness and lag in terms of when the cash does reach the GP or the investor. So that's why at the end of the day, it's very hard. It's never going to be easy to read and predict earnings of a GP for all those reasons. And that's also why I don't see them as incredibly exciting for a public side investor, because of all that complexity. And it will always be a black box, because even if you had access to all of the internal accounting, it's going to be very hard for you to form a view on, okay, within that fund, company A that they've been owning for 5 years and which is marked at 100, can it be sold next year? Can it be sold at 100? What's the probability that they get 80? Will they sell if they get 80? What's the probability they get 150? Who could buy this company? There's so many variable and so many underlying. That's why I see this as a very, it's the law of great number. Once you reach the size of a Blackstone, you have like $1 trillion of assets under management. You probably reduce the noise and the lumpiness, but you also reduce the alpha and the overperformance of some of these assets. And that's why I think, if you know how to invest on the alternative side, it's not necessarily the most exciting investment.
But so Jean-Baptiste, so looking at a basket of listed private equity companies, there's an Invesco ETF. It has not done very well. So that confirms your thesis. But looking at the best ones, Apollo, Ares, and Blackstone, KKR, maybe those best performing GPs, they've beaten the S&P public markets, and they've also, I assume, beaten the LPs. I mean, this performance is just so good. I know Apollo says they have 40% IRR, internal rate of return, on LP deals. The actual rate of return is much lower. So maybe Apollo, they've done really good. But the GPs, for some companies like those listed, I just said, the GP performance is better than the LPs. I think that's true. But that still doesn't entice you.
Well, it's, if you disaggregate growth drivers, well, first of all, we're looking at a very short period of time. I tend to look at, public markets performance over a much longer period to understand volatility and cycles and all the rest of it. These GPs haven't been around for 20 years, obviously, and some of them only for a few years. Probably max 10 years for the US, and Europeans, it's a handful. And even if you were to say, and again, that period hasn't seen a down cycle. All you've seen is COVID, which is very hard to read, and it's like a blip and a rebound for everyone. And then when you zoom in, so it's been over a period which until 22, 23 was an absolute golden era. And so only the past couple of years, I would say, you enter into a correction. Now, these managers, nevertheless, have been, as we said earlier, for the reasons we described earlier, have been growing a lot. And so it's actually the assets under management and how investors are seeing the trend in these assets under management that has driven a lot of the stock up. In the case of Apollo and Blackstone, that's certainly the case. And in the case of Ares, it's been this, fad. What I think is a fad. Let's see, let's talk again in 2 or 3 years and let's see what happened. But that has been, it's like AI, right? People have been speculating that Ares was the absolute poster child of this private debt era, and partly they were right. And when you, instead of raising 10 or 15 billion, which is already a big sum, you raise more than 20 billion. Of course, your assets under management take a big bump, and your fee stream and your carried pot are just way above expectation. So I think if you were to disaggregate, I haven't done the math, but I'm pretty certain that if you were to disaggregate the driver of these growth in Blackstone, Apollo, and Ares, it would be a lot due to growth of assets under management in the last 2 or 3 years. And this is where I'm sure they will continue to consolidate, and therefore I'm sure they will continue to grow. I'm not sure they're going to grow as fast for the next 5 years as the stock market suggests. And this is why I'm a bit, on the fence in terms of buying those stocks.
Got it. And I think there is an element of, there's huge drivers that aren't yet represented in earnings. The stocks have trade bait us on the growth in AUM, even though that growth in AUM, not all of it is fee earning and the like. So I understand
True.
that. Jean-Baptiste, you think that the remarkably high returns of private equity and private credit over the past 10, 15 years, it's unlikely to repeat and returns will be lower. And by the way, I'll say, I think, Mark Rowan, who I've got a lot of respect for, he said that in terms of private equity, he thinks returns will also be lower for many of the same reasons. But do you think that there's possible for there to be, not to be dramatic, but a catastrophe event for private equity and alternative assets in the way that there was in 2008 for the banks? Or do you think that is impossible because of the not mark to market, but there are no capital calls, or they're very slow? No one, investors and investors in private credit and private equity, they can't demand their money all at once. It's very, very slow moving, and it's unlikely for the house of cards to fall, even though there are things that are building up, like in a lot of private equity alternative assets lend to other alternative asset firms and deals, and they also own other deals. Like that to me sounds like there's a lot of contagion risk. Like if JP Morgan owned a lot of Bank of America, like it's very connected. And there's a lot less regulation in alternative assets. So what do you think?
So a lot of great questions. So let me start with risk of another 2008. I think there's a high risk of another financial crisis ahead of us. Absolutely, but not. I don't think it will ever come from private equity. I think it may come from commercial real estate, from an AI bubble, from there's far bigger asset classes which are right now very frothy. You look at the Max 7, you look at the concentration of the S&P, you look at where the Max 7 are trading compared to the rest of the S&P. You look at previous asset bubbles. There's just so many risk of bubbles bursting out there, which are much, much bigger than the whole of the private equity industry. So is there a risk of a financial crisis? Yes, but not from PE. I don't think so. Second, if this happens, will PE be affected? Yes, of course, like it has been affected in 2008, but not in a house of cards type of scenario. What happened in 2008, 2009 in the PE space was not that suddenly you had a wave of bankruptcy or firms disappearing. The beauty is that what we said earlier, the beauty is you have much more time in the PE space, because commitments can't be withdrawn. It's not really an option to default on a commitment. You don't need to sell all of your assets over at once or whatever it is. So what happened in 2008, 2009 is you saw a dramatic drop in fair value. There was, if you remember, and maybe you were too young, but I'm sure you read that. There was the wall of debt. Everybody was talking about the wall of debt because there were maturity that were gonna, you typically borrow for 5 or 7 years because you need to keep your assets for longer. You were gonna have to refinance and still holding the asset, and banks were closed for business. So people were like, "Oh my God, there's a wall of debt. This is all gonna crumble." It never happened. Why? Because nobody has interest. any interest in putting everything in bankruptcy. So banks would typically accept to extend the maturity. They would reprice, obviously, but they would extend maturity. So no one had an interest in having a fire sale of all the assets.
And this was in
being
2008, 2009?
Correct.
Okay.
And so what happened was this wall of debt never materialized. Everyone sort of muddled through. You had a drop in performance of PE, but commensurate with the drop of performance on the public side. So no drama there. And then guess what? The vintage in 2010, 2011 was one of the best we've ever had in history. So granted, the Fed was helping, but still, valuations had dropped massively. So the 2006 and 7 vintages were poor, but people felt, I'm sticking with a good manager. They're great performance before. There's a great window of opportunity now. And eventually, the most of great managers survived without any scar, and then ended up raising even larger funds after. So I think if tomorrow you had a similar crisis, I think you would see a similar thing. It would probably accelerate the consolidation, though. So people who are already finding it hard to fundraise would probably go into runoff and say, listen, the tide is just too strong. But and you will see a drop in performance. It will aggravate what we said about the drop in returns. But I don't think you're going to see any drama on the PE side. And thankfully, PE was already well equipped to navigate those storms back in the day. It has managed to navigate the COVID crisis. Again, there will be a few casualties in a few funds. There will be a few bankruptcies here and there, but not. I don't see any drama. Where you have a point on leverage, it's not so much the fact that suddenly you need to all of your companies are in bankruptcy, but the fact that the funds are much more leveraged than before, because you have, of course, leverage. I'm talking about LBO now. You have leverage on the company that you buy, but there's been a big use of NAV financing, so funds using the underlying to also raise some debt. So now you have 2 layers, sometimes 3 layers of leverage on one particular fund. Of course, the classic, if valuation doesn't go the right way, it's going to just hammer your performance, and there might be losses along the way for some of the lenders. But it's not going to kill the asset managers. It's going to have a dramatic impact on performance. But if they are the kind of Blackstones or whatever, it's like, if you remember, Hilton was supposed to kill Blackstone back in the days because they did this deal at the worst possible time. And it was a huge transaction, even by Blackstone standards, ended up being their biggest capital gain ever. So again, experienced fund managers know how to navigate these storms, even if it's never pleasing, and returns will probably be affected.
And if there is a financial crisis and the private equity GP stocks that we talked about that you currently don't own, they go down a bunch, will you be hunting for some bargains, perhaps?
I might, yeah. If they go down by a significant amount, and they probably would, because there will probably be a sort of a, there's always a run for liquidity. They will see this as at higher risk of low liquidity in the future. It's hard to understand from the outside, as you've said yourself. So they some of them might get oversold, in which case, yeah, I might find a few bargain in there.
And JB, I don't know if this is going on in Europe, but there is a push in the United States to make private equity and private credit, which up until now, I believe only investor to institutional investors, qualified participants, and maybe accredited investors as well, available to everyone. So, for example, Apollo is going to be launching an ETF, or plans to launch an ETF of private credit with State Street as the ETF issuer, and then KKR is pushing to have, I think, private equity or maybe private credit in 401k. What do you make of this?
It's a macro trend, and Europe will. It's a classic. Most of the time in the finance industry, if something is happening in the US and it sort of makes sense, it comes to Europe 2 years later. Europe tend to be a follower in that field, but you're already seeing it. I've always felt there was no reason why individual investors, retail investors, wouldn't have the ability to invest in PE, because it's, at the end of the day, if you are with good managers, especially if you are diversified in terms of managers, it's a very attractive risk return, and that should belong to to a lot of portfolios. So you're also seeing that trend on that side of the pond for sure, and I think it's a mega trend. I think this is where the Blackstone and the Apollo and the KKRs are seeing a lot of growth ahead in terms of funds being raised and in terms of assets under management. And you're going to see that it's a global trend. Again, I don't see why retail investors wouldn't have access to these products, just like they've been developing their understanding and investing on the public markets. The same should happen on the private side, and it's a big trend.
Interesting. But it is a risky asset class, yes?
Yeah, just like stocks.
Mm-hmm.
It's absolutely. But appreciation of risk is always very qualitative. Unfortunately, it's very hard to put into numbers. But I've always found, as long as you understand the managers and you understand how they're deploying capital, and you're comfortable with the future, I've always felt the risk reward in private equity is very attractive. We talked about how yields should go down, but I think public market yields will also go down, and I think the margin that private markets have offered historically versus public markets will remain. So I think in absolute term it's going to go down, but I don't think the sort of the spread public versus private is going to be compressed. And I would add that there's another interesting trend if you are a wannabe private equity investor, which is the emergence of secondary. Historically, people viewed this as, A, it's risky, but I don't think it's more risky than investing in public markets if you invest with the right managers. And B, it's illiquid. And it's never going to be as liquid as public markets, but it's getting more and more liquid with the rapid rise in secondary markets, which is yet another trend that's going to help broaden the set of investors and attract retail investors in particular.
JB, so most of your private equity career, all was in Europe. What are some differences between European private equity and American private equity, or Asian private equity? And then also, I know in public markets, you've got a rather large valuation difference. The S&P 500 valuation about 23 price to earnings, European about 16 price to earnings. Do you also have that steep of a change in valuation between European private companies and American, or no?
Yeah, I would say in terms of comparing the two regions, you probably would say the same things if you compare them in terms of public markets. The US is X times deeper than Europe in terms of not only on the GP side, but also in terms of set of opportunities. So the imbalance, it's very surprising, but when you really look at the math, the supply-demand imbalance is more attractive in the US than it is in Europe. You don't have this huge imbalance of a lot of money chasing too few deals. So more depth and better supply-demand imbalance in the US. You have the US. I mean, it's obvious, but the US is one country, one set of regulation, one market when it comes to lending, etc., etc. One bankruptcy law, one blah blah blah. Europe is gazillions of countries, so there's a lot of complexity. It's always the same story. A lot of complexity in regulatory, and it's never really a single market, even though on paper it should be. But there's so many cultural differences, distribution differences, purchasing power differences, etc., etc. So the ability to really crack a particular nut in Europe is always going to be more complex, even if it's the same sector, and if you compare to the US. And the third big difference, when it comes to valuation, I'm not entirely sure. I mean, it's very hard to measure because you don't have enough data points on the private side. But I'm not even sure that this gap that has opened between US and Europe on the public side is as big when it comes to the private side. In other words, BlackRock recently published they've measured the premium or discount between Europe and the US on the public side over the last 20 years, and it was sort of always between 0 and 10% discount for Europe versus the US until the recent period. And now a big gap has opened. And it's like 40% discount in Europe compared to the US. And you see that it's a bit of a spiral in which Europe has entered, because you look at the inflows, public inflows in 24. US attracted a net of $400 billion. Europe lost a net of 50, and it's really widening this gap. Now, on the private side, I'm not sure you have a 40% discount for, same company, same sector, same size, whatever. You probably do have a discount nowadays. And, the way public markets have trended, plus the dollar on top of that, where euro dollar is at parity now, you probably now have a discount that has appeared, a real one. I don't think it's going to be 40% though. I'm not sure multiples are showing a 40% discount in Europe. So you still need to make sure you navigate Europe properly. So net, the US LBO market will always be deeper, more attractive in terms of set of opportunities. Europe is still large enough to represent, again, something that you don't want to discount. Asia remains small, so Asia is still a small market for that. But I'm not sure it's a crying buy opportunities nowadays.
JB, thanks for giving us a thorough tour of private equity. It's a fascinating asset class. I don't think that I, as a journalist, have interviewed enough people about alternative assets, because they are extremely important, especially on the private credit side. I know now that you're retired, running your family office, you're a visiting lecturer as well. You have more time to think about broader macro issues than just hammering, spending 80 hours a week on a particular deal. When it comes to macro topics, and on your blog, wautier.co.uk, you share your thoughts on these issues. When any macro issues, whether it's globalization, trade, tariffs, inequality, AI, what is you're thinking the most about and keeping you up at night, and the topics that you think are the most important and interesting?
Of course, one will resonate with you, but it's monetary policy, because I don't think we've seen yet the great unwinding of those 15 years of crazy QE, zero interest rates, and we've and PE is no exception to that, but been booking assets, seeing asset trending always the same way, putting leverage front, left, and center, and now we're inheriting huge fiscal deficits, huge public debt, and interest rates have gone up quicker than ever in history. And I'm not sure we've seen the full scale impact of this yet. And thank God, because it's a big unwinding from every aspect. But this is where I'm a bit worried, because I don't think it's an easy unwind, and I think it's a huge, it's too many years and too big a stock of debt to GDP across the globe to unwind nicely. So that's one, and I'm fascinated by how much central banks have been behind the curve, for the last 18 months, and we're still thinking that they were spot on, just like in 2007. It really reminds me of this. So that's one. It's really monetary policy unwind, and how we're going to manage those massive stock of debt and those gigantic public deficit, be it in the US or in Europe for that matter. I worry about both, and I worry about the US even more, and then because of its size. And then the other one is AI, because I truly believe it's an industrial revolution in terms of its magnitude and impact on the economy. But it's a very peculiar one, because it's taking it's a revolution that will take from start to finish 20, 30 years maybe, whereas the previous ones would take 60, 70, 80 years. So it's an issue because you need time for companies to die, other companies to be created, people to be reskilled, education to take stock of the new environment and train the new skills. So that's an issue. The second issue is we don't yet see the big impacts on productivity and wealth creation that one should expect from an industrial revolution. Maybe it's going to come, but I observe one thing, which is you look at the Max 7, which are the largest companies today in terms of market cap, and admittedly the leaders of this industrial revolution. They probably, even at PPP, they're probably much bigger than, I don't know, in General Motors or IBM or Exxon back in the days, but they employ far less people. Those large US leaders used to employ 500,000, 1 million, 2 million people at their peak. Today, Google or Apple employ 100 or 150,000 people, barely 200,000 people. Sorry. So that's why I'm not seeing where all of these jobs are being created. And all of this wealth being created, and you don't see it yet in the productivity trends. And the third thing is every industrial revolution had an impact on society. So, computer, internet, car, travel, etc. But this one, its impact on society is to just replace humans in a lot of things, and it's hard to see how we're going to replace, I don't know, all of these doctors or designers or whatever by coders, because even coders are being replaced by AI, because AI is great at coding itself. So I'm trying to think, okay, is it just that we're too early and it's going to come? And maybe I could have said the same thing at the start of each industrial revolution, but still, because it's a net replacement of humans and human intelligence, and it has sort of an exponential growth in terms of its capabilities, as you would expect. Isn't it going to be the first industrial revolution that has a net destruction of jobs, which might be good for society as a whole, but what are those people going to do then? And maybe there's a very optimistic perspective on we're gonna spend more time looking after each other. We're gonna spend more time creating and being artists, but maybe I've been in the finance industry for too long. I'm too cynical to look at it that way.
Yes, I guess people did say the same about the plow, about the car and the like, and people did find jobs elsewhere because people left the farms, but suddenly they work in the factories. Oh, people leave the factories, they work in an office. But it seems that with this, like, what is the next job going to be? I guess part of what I do is like a content creator and a person, but like, are there really going to be 20 million podcasters? Like,
Exactly.
they're going to be 1 million rappers and singer songwriters. It's a tough field, and just like with private equity, the more people get involved, the more competitive it gets, the more difficult it gets.
Absolutely.
So it's an important question. JB, thank you so much for coming on Monetary Matters. Where can people find you? On wautier.co.uk, and then you're also
wautier.co.uk. Yeah,
and you're
on
also
YouTube.
on LinkedIn. And then yes, tell us about the 4 consumer companies you are still involved with, the charities and the World Economic Forum as well.
Sure. So there's a lot in this new chapter. Indeed, from the family office, I'm still an investor. Once an investor, always an investor. So I still enjoy doing this. It's back to my roots. The theme is consumer focused companies, founder led. They've proven that they had the right to exist. They're sizable, they're profitable, but they need to scale. They have the ability to become much bigger, much more global. And founders typically, don't know how to do this. So I'm trying to, and each of those 4 have a similar dilemma, and I'm trying to help them So of course I invest alongside them, but in a minority position, and I try and help them scale, build a management team around them. I mentor them, I help them with their board and the rest. So that's one part. Then there is indeed all of the academic and thought leadership with no pretension, but it is trying to share a few thoughts, and it's both micro and macro. So it's on LinkedIn, on my YouTube channel, and also I write pieces for Les Echos in France, for Project Syndicate, work for a few think tanks, and then there's philanthropy, which mainly focuses on two things. One is education accessibility, and I'm absolutely passionate about making sure that education remain accessible even to the ones who were not born in the right place, to the right parents in the right neighborhood. And this is something I've been doing a lot over the years, and I'm doing even more now, with not only money but also some of my time. And another one, which is close to my heart, because we had the issue, the case in the family, which is spinal cord injury, where there's a lot of excitement for people who've had accidents, strokes, and stuff, and who end up being paraplegic or tetraplegic. There's a lot of excitement around brain-computer interface and all sorts of new therapy, where we are that close from having solutions for these people. And so I raised a philanthropic fund. It's like a venture fund. It's a $30 million fund where people who have invested have actually donated that amount of money to make sure that it's being deployed to the right technology. So that's taking also a chunk of my time.
Very nice. JB Wautier, thank you very much for coming on Monetary Matters. A reminder, people can find Monetary Matters not just on YouTube, but on Apple Podcasts, Spotify, wherever else they find their podcasts. Thanks again.
Thank you.
Thank you. Just close the door.